Hi there folks, welcome back to the EdgebyRS Academy. I hope you guys are enjoying your weekend and had a good trading week. For today's session, I'll be walking you through the week of 10th June. Now, unfortunately last week I had a terrible throat and I couldn't record, is why this week you will receive two recordings from me. One is for the week of 10th June and then the week of 17th June. Quick reminder, I did not roll over until the expiration, which was on Friday, which means all my levels, all the references that I'll be making in these recordings will be from the June contract, which is ESM. If you guys did roll over any earlier, all you will have to do is add 64 to 65 points to the levels that I'm talking about, and you will have your references in ESU, which is the September contract. So, dialing back, the week of 10th June, it was a unique week. And why do I say unique? Because on 12th, we had both the CPI as well as the FOMC on the same day, which meant and given that it was middle of the week, the entire week was guided by one strategy. That is the event strategy. Now, I've spoken about this in multiple of my recordings earlier, but as always, to become good at something, repetition is required, and that is what these recordings are all about, to remind you about important concepts, introduce new concepts, guide you on how I think, because that's the most important part, how you think. There's always going to be a long, there's always going to be a short, there are always two kinds of trades at any given moment, but it is how you have dissected the MGI, the context, the structure that's ahead of us. That is where the real difference is made. So, as you guys walk through these recordings of mine, do not think of these as hindsight. This is pure foresight that I talk about, because this is what I have executed live in Discord. Now that's the beauty, right? I cannot teach you live. That's not possible. So instead, you have these weekend classroom sessions. So all trades that you see are recorded. All trades that you see have been called out live or have been zones marked in the charts shared on Discord. So if you guys are part of Discord, you already know this. For the few who are not, again, I do share a few trades that I take. They are shared on Twitter. They are shared in Substack weekly review as well. So give it a look. Again, if you have any questions, you can reach out to me. So without further ado, let me switch my screens. Now, if you recall, and this is your homework, by the way, guys, these homeworks are very important, and I'm extremely glad to say that a lot of folks are reaching out to me with their homeworks. Now, again, last week, 10 days, I've been struggling with bad throat, so I've been a bit slow overall, but again, you guys can expect me to be up to speed during the course of the coming week. That said, the first homework, look back at the ESM contract. That's it, nothing else. 3 months, that's all you got to review. And again, very specific, ahead of events. Look at a week or 10 days ahead of events. And what you will realize is a repeating pattern. Guys, markets is all about patterns, right? And that's how, what is market memory, right? A lot of folks talk about it, but it is this inherent patterns that keep repeating. That is part of market memory. Similarly for us, memories are birthdays, anniversaries, I don't know, childhood memories, etc. These are all memories, and they do help us remember certain events of our life. It's the same when it comes to markets. Market memory is all about markets remembering certain events, and in all likelihood, they do tend to repeat, like it happens with all of us, right? We may be distinct individuals, but we all share the same memories, which is birthdays is equal to happiness, and excitement, those childhood memories, they're all the same. So, similar to markets. Now here, I'm talking about the entire ESM contract. When you review ahead of FOMC, ahead of CPIs, week 10 days earlier, all you will always see is there's either a double distribution or a triple distribution that is going to guide the event week. Now that's the important part. And here we are again on 5th of June when we had a double distribution that developed ahead of the FOMC and CPI. Now, why is this double distribution important? Because this double distribution helps us understand strength. That's the most important part. How strong are markets ahead of events? What's the positioning like? So as you can see here, we broadly remained within the upper distribution of Wednesday. We had an pre-market test down here. I think this was the NFP candle, right? And then we again did come back during RTH. Now, what's the most important takeaway here is that the single prints here, they were left unfilled. That is, this was an ETH test, which is a pre-market test. So singles are not considered filled unless seen during RTH. And then on the 11th of June, we did drop in here, but they were partially filled. And what does that tell us? If singles are left unfilled, in this case, the trend is up, which means the market is quite strong. And if you recall, from the weekly plan that I shared for the week of 10th June, I explicitly noted that any backtest into 5330s will be nothing but a technical fill. Do not consider that as weakness. It is simply a market function, because while we are waiting for the CPI and FOMC, markets are likely to correct or attempt technical fills at specific areas. It could be value gaps, it could be singles, it could be weak lows, poor high, poor lows, etc. So as you can see here, we partially filled. And again, if you recall in Discord, I called out this trade live that anywhere between 53.27, 53.37, I am looking to take a long. And that is exactly what we did in Discord. And the idea was very simple. On the back of single prints, we are taking long. I'm not expecting a breakdown ahead of the event. This is what we know. No breakout, no breakdown ahead of the event. That's 80% of the game, right? 20% is always the outlier, which we got to assess and tackle with real time. But as long as the 80% is understood well, then we are winning 8 out of 10 times. Even those 2 times we get it wrong, still net PNL will always be green. So again, we had this upper distribution from Wednesday, the 5th of June, held NFP, that's event 1. We held it. Just think about it, guys. When we are holding the upper distribution, very simple, event after event, that is bullish. I don't care what my bias suggests. I have to see what the market is telling me, and through these developments and holding of the single prints, holding of the upper distribution, all markets are telling me, listen, I am bullish. This is a long. Any pullback is an opportunity to buy the dip. As simple as that. Again, we had this NFP candle, and thereafter, look what happens here on the 7th and on the 10th. We leave behind a weak low. Now, why do I say a weak low? Because as you can observe, the RTH session low on 7th of June and the RTH session low on 10th of June were exactly at the same level, that is 53.41. So not only do you have these singles left behind ahead of the event, which is the FOMC and CPI, but you also now have a weak low. And what does that tell me? That already tells me on a Monday, end of session Monday, that we are going back down to clean this up, because really we aren't breaking down ahead of the event. And if we are, let the markets prove to me, right? And if they had to prove to me, they had to be above this. Just a second. They had to be broadly above 53.70s, which is also holding above Wednesday's high. Absent we did not find traction above NFP high, absent, and what that tells me is this is resistance. This is where we shorted. I remember shorting on the 10th. I also called out the trade live on the 11th morning, which is London session. Guys, this is a short. I'm taking a short. And ultimately, you can see how we've rolled over to clean up the structure here, right? This is a magnet ahead of the event. We cleaned it up, followed by a partial fill of the singles. Why do I say partial? Because the bottom of the single prints right here is at 53.30s. Did not happen. We did not even backtest during RTH session the entire NFP candle. Again, all of this talks about strength. So right here, guys, when I'm talking about the overall structural strength that is there and the technical fill being present, all you guys want to remember is on the 11th, we opened on a value gap down. Now this is a twofold play, right? This is multi-dimensional markets. We first had a poor structure here, which we cleaned up, the single prints, we cleaned up the weak lows, formed a very good looking excess. And what do we know at the same time is we do not leave gaps open ahead of the event, which meant leaving this gap open, flushing lower. Now, had you caught this, fantastic trade. Now let's say you missed this for whatever reason. You don't need to get frustrated because you exactly know what the next play is. The next play is to go for the value gap fill. Not only that, we also have the singles right here, the single prints between 63 and 65. We've got the London session single prints. So we've got two good looking magnets here, and again, we are not breaking down. So longs from 53.30s, given that this drop was a technical fill, something that I already gave you a heads up on ahead of this move materializing. And as you got this move, your immediate thought is to look for longs for the value gap fill. And that's precisely how the action developed. So guys, again, let's walk through this. 1. Held the upper distribution, held the NFP candle. That is the highs of NFP candle acting as resistance, weak structure below, poor structure below, which means these weak lows will get cleaned up and even attempt for the single prints and also go for this NFP ETH candle retest during RTH. So we had good three well-defined structural magnets. We exactly knew where the resistance was. We knew exactly what is going to invalidate the idea. It's very important to know, guys, what invalidates the entire idea, right? And this is why you will always see me executing at the edges. And when I say edges, these are key levels which act as then pivot to flip the direction. And as we knew here, this is the top edge. We've got the balance stop right there. We know these magnets are below, which means the upside is no more than 10 points and the downside is looking good with up to 30-40 points to be taken. So there you go. That's your risk reward, and that is when we do take those positions where I do in order to target for these magnets. Now as we clean this up, again, we cleaned the structure down below. We cleaned it up here by filling the value gap and subsequently the single prints from London session. Now what's important, guys, right? This is very important. What happens after these structural references are cleaned up? After the structure has been repaired, all done. What happens after that is your next big clue. And look what happens here. We actually end the session on a spike at the balance stop. You know what what the action by end of Tuesday told me? This is turning out to be bullish. Why? Because if I just drag this upper distribution to the to the right, what do you observe? A very strong breakout that held on pullback into the balance stop. Certainly not a location I want to short ahead of the event, but definitely tells me that the FOMC and the CPI are likely to result in a rally first. I don't know what happens next, but at least we know it's a rally first. Again, not the location to look for longs at the balance stop, that's reckless. All it tells you by end of day is if you've got the longs at 53.30s or on the acceptance of 53.52, which was our weekly buyer zone from the weekly plan of 10th June, we exactly know excess held the balance bottom, left behind the singles, broadly held the Wednesday's upper distribution, cleaned up the week low. Weekly plan buyer zone has found acceptance, list framework acceptance, back above value area low from the prior session. Guys, this is all stair-stepping to confirm the structure is bullish, the context is bullish, and any move lower, like I said, was a technical fill. So when you are trading day after day, always look at these clues. Where are we? Are we holding certain distributions from prior session, prior week? Are we reclaiming value area high? Are we reclaiming London high, London low, which I often refer to as EU high, EU low? Or are we taking back the buyer zone or the seller zone from the weekly plan? When you put all of this together, you will realize within a 15-point range in most cases, right? Again, 8 on 10, this happens. You will realize within the 10 to 15-point range, you will realize there's a hell lot of confirmation that's come through, and there's nothing for you to do except hold those runners. This is why I always tell everyone, guys, your minimum profit is 7 to 10 points. And thereafter, observe the structure, because your runners will be confirmed within those 10 to 15 points from your entry. Because assuming I trade the edges, and so are you by following me on Discord and my plans, by following my plans, so we know that within that 10 to 15 point range, we'll have confirmation and we can hold the runners. And look what happens. While I did not initiate any position here, but my longs from 53.30s paid me all the way into 54.40s, 54.50s. And that's the beauty of runners. The magnitude of these moves due to events and your confidence based on structure allows you to manage your position, your runners more smartly, which means typically a lot of traders may be like, okay, let me take 70% off. But as you gain confidence, as you understand these strategies, as you understand how the structure is developing, how the context is developing, you will then be able to hold your runners instead of 20 or 30%, maybe even up to 50%. So that does happen, but happens in due course. So that's how we navigated using the clues of 5th June and the 7th June to guide us up until 11th June end of day. Now comes the next part, which is literally the event. We took off post release, but observe here, right? How did that takeoff happen? We attempted a back test of 53.85 first, which means in that initial 10 seconds, we defended the top of the 4-day balance. Now, can we join this rapid, swift move to the upside? Very difficult. Trust me, I don't even try doing that. What I try to do is being positioned either ahead of the event or then just look into it after the release is done. So, no trades for me here, but again, this is the most important clue, that the first 10 seconds and we held the top of the balance. And what that told me is, this is bullish, simple. Plain, vanilla, simple, this is bullish. And look what happens now. This is your 30-minute candle. Now, as soon as we are done with the 30-minute candle, let me just switch to 15, right? Real quick. So there you go. Now observe. We break out, there's a pump, okay? And now there's a back test. Now observe this back test. This back test is very important because what that tells you is whether the initial 15-minute pump has any merit. And this 15-minute pump could be a dump some other day, but the idea is still the same. What happens in the subsequent 15 minutes is very important because it actually tells you is whether there has been acceptance or not. And what this tells me, after that subsequent 15 minutes, let me switch back to 30 real quick here now. We are holding into the open. When we hold the upper distribution, again, just think of this way, right? Split this candle into two parts. The top 50% is your upper distribution, the lower 50% lower distribution of the candle, right? Now, when you're holding within the extreme upper end of a breakout candle, that is an event candle, okay, not just any breakout. This is an event candle, hence it is very important. When you're holding the upper 20%, the upper 30%, or even the upper 50%, what that tells you is there's outright acceptance of the move. Because if the move is being rejected, trust me, you will see an instant reaction of 15 minutes, the first 15 minutes being a pump and the subsequent 15 minutes being a dump. But when that doesn't happen in those 15 minutes, and we are at the upper end for the subsequent 30 or 15 minutes, that is your signal. This is still bullish. Now remember right here, this is a gap up open, which means when you have a large, see, if it's a regular day gap up, normally they are 10 points, 15 points, 20 points, 25 points. But just look at this. To the top of the candle, this is a 50-point gap up. When you see a 50-point gap up led by events, and that is typically when it happens, that is led by events, we see these wide gaps. That is when you instantly want to think, okay, where is the exhaustion, right? Because it cannot be 50 and another 50 on top of it. No way. There has to be a pullback. There has to be consolidation. I don't know, maybe it's like 1 in 1,000 chance of you seeing a 50 gap and another bill of 50 points. Doesn't happen that often. Rare. So we know this. Event-led 50-point gap up. And what's your next thought? Where is the exhaustion? Where is the resistance? And this was the resistance from our weekly plan. That is the week of 10th June. This was the resistance in my daily plan. So we already knew this is resistance. Now, how much higher can this extend though? That's the question, right? The answer is simple. Go with 50%, which is another 15 to 25 points higher. Because what happens is 99% were not positioned, let's just say traders, right? Short-term traders were not positioned for this pump, right? Because not everyone has the kind of view that we do. Our lens is very important. Like I said, our thought process, our ability to dissect the information that is available to us is where the edge truly lies. So a lot of times traders then try to join the momentum, and look what happens is we tend to rally about 15 to 25 points, and in this case we did about 20 points. And we know this is very standardized. This is how it works 8 out of 10 times, like I said. And now what happens is, where does this 15 and 25 points add up to? It lines exactly at your resistance. Not only that, if I take the event candle all the way to the top, 65 points, again, recall, above 54 points, we start hitting intraday exhaustion. Now, we're going to bring in 3 factors. Simple. 1, intraday exhaustion hit plus 50-point gap doesn't hold in entirety, right? It can hold, like I said, 10, 15-point gaps are very different from plus 50. So as you can see now, we are about, wait just a second. As you can see now, we are holding about a 22-point gap. It's no longer 50. So as we know, the retrace will happen, which means exhaustion. What's the confluence at exhaustion? Then 15 to 25 points higher is possible to continue the momentum, and then there's going to be some sort of reversal, some sort of exhaustion. That's one. Number 2 is intraday exhaustion, which is set at 54 points. So we had already surpassed that. So we know we are into extended territory. Third, you've got my weekly resistance, you've got my daily resistance marked right there. So you know it's all confirming that we are extending. And again, this is a 50% of the CPI candle. So plenty of confluence that confirmed that this location is a short first. Now, guys, this is your homework, and this is the only point I'm going to disclose once you reach out to me. That is, recall my earlier recordings, and I exactly shared with you why I would have picked this zone. I want you guys to tell me, because see, all of this that you see here is real-time confirmation of exhaustion. What you want to remember is I had given you this zone literally a week ahead of time. This is a zone, and this is a zone where you had no prior price action, right? So this is clearly a zone given to you much ahead of time, much before the CPI candles, much before any of this development occurred during the week, which means there was a reason why I picked this zone. And I have explained this reason to you guys in the past. You may remember, you may not remember, but just try to spend some time, focus on why my resistance was here. And then once you reach out to me, I will just tell you it's actually quite simple. But again, I want you guys to, what do I say? Do this homework. It will help you with building your memory, flexing your muscles. So just do that, okay? So there you go. This is where we found resistance and the subsequent pullback. Now, what's important is right here is, a lot of times we talk about common sense, right? I'll just say market sense, because common sense is in general life, but market sense is very specific, right? So the market sense tells me, and this is what I even commented on Discord. I don't know how many of you guys would remember, but if you don't, reach out to me. I'll point you to that post in Discord. But I clearly said, guys, I don't see further upside from here, irrespective of what FOMC does. Now, why is that? Understand, we are already on a large gap. We are already coming off the lows of prior day into the top, which is 119. Recall, weekly exhaustion is 108 to 117. So we've done 119 already. So yes, there could be like I said, a 10-15 point pop. That's fine. But that is not structural. That we know is just initial euphoria, initial reaction, and then it reverses. What's important to notice, we've already run up enough, which meant FOMC had to be something super rare for us to see a continued run up higher. And look what happens is the release candle of the FOMC right marks the top right at 54, whatever that number is, right? 52, 54, 52, 54, 54. Right here we mark the top. So that's your two event tops right there. CPI, RTH session, FOMC, initial reaction, initial 30 minutes candle, release candle, right? Sorry. So you had those two tops there, which means it's an important one. And now it became an automatic fade because, like I said, remember, when we make these big moves, there has to be consolidation first. It is, again, extremely rare that you will find a continuation above those 120 points that is sustained. That's a very important point to remember. Sustained run up, which meant we need to consolidate. We at least need to test 50% of this candle. If you guys recall, go back, and I think it was the NFP, which is not the June 7th, but the NFP which was released in May, if I'm not mistaken. We had the NFP candle retrace exactly between 50 to 60% to backtest the FOMC high at 51.27. Now there you go. Go back and you will see 50%. So 50% of CP of any event candle becomes very, very important. And that's not the only candle. Look back again, look left. See, I remember numbers, okay? I don't remember dates, but I'll remember these levels. Again, we had a CPI release from 53.72 or 75 all the way to 53.03. And you will realize on that day as well, we retraced 50%. Now, certain times we will retrace the same day, certain times it may take a session or two. Again, understand the magnitude of the move first, because that tells you if it's 50% or more. But at the very least, 50% happens whenever there's a large move first. So that's your high odd location when you are trying to short the resistance, which has confluence at weekly, intraday, 50% CPI candle. And the secret reason for having this resistance here, okay, this is the added confluence, which you'll come back to me with, and large gap right here. So we exactly know that this is going to work in our favor given time. Time is important, guys. A lot of times I see traders, they want to see their idea play out in an hour. No, sometimes the market can take a day. They can take 24 hours. They can take 48 hours, because large moves can consolidate. Indecision can continue. These are factors to remember. And with that, we had the pullback, again a rise. We had PPI here, again same place, another rejection, and ultimately on Thursday we saw the 50% of CPI candle retrace, release candle retrace done. We held, again left behind a weak low and continued higher thereafter. Now this is a location I expect a retrace eventually. Now all you have to do is really add those 64, 65 points, and we will be at the ESU level, and ultimately even ESU, I do anticipate it to print these levels again. Much on this later, but this is how we navigated the week of 10th June tactfully, understanding the structure. We exactly knew it was bullish from day one. We had the recognition that any backtest will be a technical fill and not a change of trend. That's precisely what we got. Leaving the value gap behind enabled us to take these longs with more confidence, because again, we rarely leave gaps behind. Add those single prints here truly helped. Large gap, think about exhaustions on multiple time frames. Look at the confluence that was available. Again, add to the fact this was the IB high, which meant, just think about it, right? Balance breakout, CPI candle, release candle holds, then you have a period A breakout. Now you're talking about period B or IB breakout all ahead of FOMC. Not happening. If that's not happening, what will markets do between the end of IB period and FOMC? Is rotate lower. Can be fast, can be slow, but rotate lower. Like I said, you cannot build further on this breakout given the exhaustions and the resistance that was there. So it's very important to think in this direction, because it will make sure that you're not scared to short a trending session. In fact, you're confident on why you're doing so, because you have as much confluence here, right? So this is where comes the idea of time and price. This is very, very important. FOMC, PPI ultimately retrace 50%, and look what happens. We form a support. Now look back at the weekly plan of 10th of June, and you will realize I had the pivot already marked at 54.04 and 54.12 long before the CPI candle was printed. Now you have got two questions to ask yourself, guys. Why did I pick this and this? So the resistance has already been explained to you. Now comes this pivot part. Why did I pick this as my pivot? Now this is something that I will have to explain in much more detail, so allow me a session or two before I can circle back to this, because I need to prepare a bit of material to get on this. So just keep this back with you, and I'm going to come back and talk about this zone. So with that, we are done with this session for the week of 10th June. I hope this has added value. Again, guys, a reminder, repetition is the key to success. I may have repeated a few points. I certainly know I have brought in some new concepts today, certain new ideas today, but you got to make notes because these patterns, behavioral patterns, keep repeating. Like I said, it doesn't matter if ES is at 5400, 5500 or 4300. The pattern remains unchanged 8 out of 10 times. The 2 times are outliers. We'll have to deal with them real time. So, extract the understanding from here, make notes, and as we move into the last week of this month and subsequently into next month, where we'll again be dealing with NFP, CPI, FOMC, you ought to be more prepared because you know exactly those weeks. You can prepare for it from now. You already know the dates. They are out there up on the internet. All you got to do is prepare, understand those weeks. Once you understand how the week may look like, by default, when I give you those zones on Discord, you will have confidence because you'll be like, oh yes, this is event. This is how it's going to work. These are the confluences I have. And boom, there you go. And if you do have any questions, as always, guys, reach out to me on Substack, reach out to me on Discord, Twitter, email. I'm accessible and get yourself prepared, right? So I'm going to leave you with this. Get your homework done. Reach out to me, and I owe you guys an answer to 5304 5412. That will need a few sessions before I come back to you on this, as I need to prepare some material. But that said, you have everything that you need to continue your learning journey as well as improve your execution and continue turning those small winners into big winners. Okay, I'll leave you with that. You guys have a good rest of the week and we'll connect next week again. Take care. Bye-bye.